Somewhere right now, a 54-year-old teacher in Ohio is sleeping soundly. She checks her 401k once a month. It looks fine. Green arrows, growing numbers. She's planning to retire in 11 years. She has no idea. Somewhere right now, a 38-year-old software engineer in Austin is buying his second investment property. He's confident. The market has been his friend for a decade. He thinks he understands risk. He doesn't. And somewhere right now, a 29-year-old in Seattle is dollar-cost averaging into a tech-heavy ETF every paycheck. She's doing everything they told her to do. She's read the books. She follows the right accounts. But there's something none of them have been told. Not by their financial advisors. Not by the business news. Not by the apps on their phones. A set of warning signals. The same ones that lit up before every major crash in modern American history are flashing simultaneously. Right now, 7 of them out of 10. And the people who built those warning signals, they work at one of the biggest banks in the world. This is not a prediction. Predictions are guesses. This is a pattern, and patterns have consequences. The question is, which side of that consequence are you going to be on? Bank of America has a research team, quietly brilliant people who don't appear on television very often, who don't have podcasts, who don't post on social media. They just watch. They study, they build models, and over many years, they built something internally called the bear market signposts. Bear market. You've heard that phrase, but let's make it real for a second. A bear market isn't a bad week. It isn't a correction. A bear market is when the stock market drops 20% or more from its highs and stays there, not for days, for months, sometimes years. 2000 to 2002, the S&P 500 lost nearly half its value. The Nasdaq lost 78%. People who were supposed to retire didn't. 2008, the market fell 56% from peak to trough. Millions of Americans lost their homes, their savings, their sense of security. That's what a bear market actually is. Not a number on a screen. Not a headline. It's a retired couple eating differently. It's a family delaying a mortgage. It's a kid who doesn't go to the college they worked for. The Bank of America team built 10 warning signals designed to identify when the ground beneath the market is shifting, before it shifts. Like a seismograph designed to detect the tremor before the earthquake. They called these the signposts. And here's where your heart should start to beat just a little faster. They just turned on 7 of them at the same time. 7 out of 10. Let's go through what these signals are actually measuring, because the numbers matter less than the story they're telling. Signal 1, consumer sentiment. How confident are regular people? Not investors, not economists, just regular Americans. About the economy? Right now, that confidence is eroding, quietly. Like a slow leak in a tire. You don't notice until you're already on the side of the road. Signal 2, investor expectations. When everyone in the market believes stocks can only go up, that's called a consensus. And consensus, historically, is where the market sets its traps. Because if everyone is already invested on the same assumption, who's left to buy? Signal 3, credit stress. Are people and companies struggling to borrow money? Are banks quietly, nervously, starting to set aside more cash for loans that might go bad? Because when banks start hedging like that, they're telling you something they won't say out loud. Signals 4 through 6, structural market stress, liquidity, flow of money, technical indicators that only make sense when you see them together. But there's one signal, one specific one, that I need you to hear. Because it's the one that hits value investors the hardest. The most expensive stocks in the market, the ones with the highest price-to-earnings ratios, the names everyone knows, the companies that people buy not because of fundamentals but because of vibes, have been massively outperforming everything else. Bank of America has a phrase for this: They call it excessive speculation. Speculation is just a polite word for gambling. When the most overpriced, most hyped, most emotionally purchased stocks are the ones flying the highest, it means rational analysis has left the building. It means people are buying the momentum, not the business. And that, historically, is one of the loudest sirens before a market top. But here's the twist that makes this story truly uncomfortable. Bank of America didn't stop at 10 signals. They also measured market valuation using 20 different methods, 20 different ways to ask the same question. Is this market priced fairly? The answer came back the same on 17 of those 20 methods. No. And on 8 of those 17? The market is more expensive than it was during the dot-com bubble, the year 2000. Say that again. More expensive than the year 2000. If you know what happened after that, this is the part where you go quiet for a moment. In a moment, I'm going to show you what the dot-com bubble actually looked like from the inside, because the parallels to today are almost impossible to ignore. But first, the 3 green lights. Because this story has 2 sides, and you deserve both. Here's the balance you won't get from most financial fear content. 3 of Bank of America's 10 signals are still green, not yellow, green. And the bank itself made an important distinction. The biggest tech companies today, Apple, Nvidia, Alphabet, Microsoft, are real businesses, real revenue, real profit, real cash flows. The dot-com companies of 2000? Many of them were websites with no revenue model, funded entirely by venture, capital, and hope. Pets.com, Webvan, Flues. Companies that lost money every quarter and were valued like they'd already conquered the world. That's not the same situation. The green lights acknowledge this. The free cash flow these tech giants generate is real. Their competitive moats are real. These aren't fake companies. But, and this is a significant but, even the green signals are moving. The cash flow that these tech giants generate has flatlined, not crashed, flatlined. And here's why. These companies are spending almost every dollar they make on artificial intelligence. Not a little. Almost all of it. By year end, the biggest companies are expected to spend more than 100% of their cash flow on AI build-out, more than they're bringing in from operations. That means they're borrowing against their future to build something. Something that may become the most transformative technology in human history, or something that takes a decade to monetize. We don't know yet. What we do know is that green lights fading to yellow are still moving in one direction, and Bank of America lowered their target for the S&P 500 below where it currently trades. Let that sit for a moment. One of the world's largest banks is looking at the market and saying, "We think it goes down from here. Not that it crashes tomorrow, not that you should sell everything, but that the overall index, the average of 500 companies bundled together, may have already priced in the good news. The opportunity, if it exists, lies somewhere else." Warren Buffett once said that when he sees a market like this, he pays attention, not because he panics, but because he changes what he buys. In a moment, I'll show you exactly what Buffett is doing with $400 billion in cash, and why it says more than anything you'll hear on cable news. Let's step away from the stock market for a moment, because there's a second problem stacking on top of the first. And this one you can feel in your actual life. Not in your brokerage account, in your wallet, at the grocery store, at the pump. The word is recession. Technically, economists define a recession as 2 consecutive quarters of negative GDP growth. But in real life, in the life of actual Americans, a recession is something simpler and more devastating. Fewer jobs, companies making less money, people spending less. A slow, cold, grinding contraction. We haven't had a real one in a while. We had a government-forced shutdown in 2020 that created a technical recession, but the organic kind. The kind driven by economic stress. We've been avoiding that for years. The question now, Are we still avoiding it? Mark Zandi is one of the most respected economists working today. He's chief economist at Moody's Analytics. When he speaks, central bankers listen. Right now, he puts the probability of a U.S. recession in the next 12 months at 40%. Normal years, that probability sits around 15%, he said. And I want you to hear these exact words. It gives you a sense of how close I think things are to the edge. Why does he think this? 3 reasons, and all 3 are things you felt without necessarily naming. Reason 1, you're running in place. There's a number economists track called real disposable income. It's not what you earn, it's what you have left. After taxes, after inflation, to actually spend. Over the last year, that number has grown by 0. 0. Your paycheck might have gotten bigger, but prices, for food, for housing, for services, have consumed that raise entirely. You are working just as hard and standing exactly still. That's not a recession, yet, but it's the soil that recessions grow in. Reason 2, the Strait of Hormuz. You may not know this geography by name, but you feel it every time you fill your gas tank. The Strait of Hormuz is a narrow waterway in the Middle East, at its narrowest, just 21 miles wide. And through that 21-mile gap, roughly 20% of the world's oil supply flows every single day. Iran has threatened to close it. Oil prices jumped 7% almost immediately. Gas climbed to around $4.32 a gallon nationally. Zondi's warning, if gas hits $5, consumer spending, which is 70% of the U.S. economy, could contract enough to tip the country into recession. And here's the detail that almost nobody's talking about. America's Strategic Petroleum Reserve, the emergency oil stockpile designed exactly for this kind of crisis, is at its lowest level in 2 years. There is less cushion than there has been in a very long time. Reason 3, the Federal Reserve is trapped. This is the most technical of the 3 reasons, but stay with me because it matters enormously. The Federal Reserve controls interest rates. When the economy slows, they normally cut rates to stimulate spending. When rates are low, people borrow more, buy more, invest more. It's the economic equivalent of pressing the accelerator. But here's the trap they're in right now. Inflation is still running above 4%, which means if they cut rates, they pour gasoline on a fire that hasn't been fully put out. So they can't stimulate, they can't cut. And here's the deeply uncomfortable fact. Some economists believe the Fed may actually have to raise rates further just to finish the job on inflation. At the same time that the economy is slowing. That's not just pressing the brakes, that's pressing the brakes while going uphill. The CME Group, which tracks what the market actually expects the Fed to do, currently puts the odds of a rate cut by year-end at less than 1%. The odds of rates going higher? About 70%. Let that land. Now, balance. The April jobs report came in better than expected. Employment is still solid. People are still spending. 40% odds of recession also means 60% odds that we avoid one. I'm not here to frighten you into bad decisions. I'm here to make sure you're not blindsided. Because the people who get hurt in recessions aren't the people who saw it coming. They're the ones who didn't know it was possible. But the most important warning isn't coming from Bank of America. It isn't even coming from Moody's. It's coming from a metric that the greatest investor alive once called the single best measure of where valuations stand. And right now, it's at a level this country has never seen before. Not in 2000. Not in 2008. Not ever. In recorded history, Warren Buffett. You know the name. You probably know the broad outlines of the legend. Started investing as a child. Turned $100 into a company worth $900 billion. Famously avoided tech stocks in 1999 and was mocked for it right until the bubble burst. Buffett has a long history of identifying, very quietly, when markets have drifted far from reality. Not by prediction, by measurement. And he once said of one particular metric, it is probably the best single measure of where valuations stand at any given moment. Here's how it works. It's simple. Take the total value of every publicly traded company in America. Every stock, every share, every company on every exchange. Add them all together. Then compare that number to the size of the American economy for that same year. GDP. In a rational market, these two numbers should grow roughly together. If the economy doubles over a decade, the companies within it should be worth roughly double. They're the engines of the economy. It makes sense. So when the total market value equals GDP, the market is roughly fairly priced. When market value is significantly less than GDP, stocks are cheap. When market value is significantly more than GDP, stocks are expensive. Right now, the total US stock market is worth more than twice the size of the entire US economy. 2 times. And here's the number that stops the room. It just jumped 13% in a matter of months. This reading, this ratio, is at its highest level since at least 1970, which is as far back as reliable data goes. Higher than the dot-com bubble peak in early 2000. Higher than the eve of the 2008 financial crisis. The highest in over half a century, perhaps ever. In the research that tracks this indicator, the historical pattern is consistent and sobering. The higher the valuation reading, the lower the future returns on stocks. Not always immediately, not in a straight line, but eventually. And the way future returns become lower is one of 2 paths. Either the market goes sideways for years, 10, 12, 15 years where prices barely move, while the economy catches up to the valuations, or the market corrects sharply, quickly, violently. After 2000, the S&P 500 went flat for 12 years. The Nasdaq, the tech-heavy index, fell 80% in 3 years and went flat for 16 years after that. 16 years. If you started investing in 2000, you were still underwater on Nasdaq in 2016. Your 401k was the same number it was when George W. Bush was just starting his first term. That's the risk that doesn't get headlines. The silent, grinding loss. Not a crash. Just nothing. For years. Now, here's the twist. Warren Buffett is sitting on $400 billion in cash. That's not a typo. $400 billion. At Berkshire Hathaway, that cash pile has been growing for years. And to most observers, it signals one thing. Buffett doesn't see compelling places to put all that money. The market is too expensive. But here's what he just did. He didn't sell everything and go to a bunker. He put $10 billion into Alphabet, the parent company of Google, to help fund its AI build-out. Privately. Not through the stock market. A direct investment. Let that strategy sink in. The man who built the most successful long-term investment record in history is looking at a market screaming overvaluation. And he's not hiding. He's hunting. Selectively. He's not betting on the index. He's betting on specific businesses. Businesses he believes are fairly priced or underpriced, even within an expensive market. He's doing what every great investor does when the crowd gets irrational. He's getting more precise, more selective, more patient. And that patience is a strategy, not a reaction. So what does all of this mean for you? For your savings, your retirement, your financial future? The answer isn't what most financial content will tell you, and it isn't what you think. Let's connect the dots. Bank of America, 7 of 10 warning lights red. Market expensive on 17 of 20 measures. The most overvalued stocks outperforming. A signal they call excessive speculation. Mark Zandi at Moody's, 40% recession probability. Real income growth at 0. Gas prices threatening the edge of consumer contraction. The Fed trapped between inflation and stagnation. the Buffett indicator, the most overvalued market in over 50 years, by the favorite metric of the greatest investor alive. 3 separate warning systems, 3 separate teams, 3 separate methodologies, pointing in the same direction. Now here's what they're all also saying, simultaneously, that the headlines aren't amplifying. Bank of America sees opportunity in individual stocks, not the index. Buffett is deploying capital into specific businesses, not the index. Zandi notes that the jobs market is still solid, that 60% probability of no recession is real. The divergence is the revelation. The index, the S&P 500 as a whole, may be dangerous to buy right now. Expensive, fragile, top-heavy with overvalued tech. But specific businesses at specific prices in specific sectors? That's a different conversation. History is instructive here. In 2000, when the Nasdaq cratered 80%, small and mid-cap value stocks didn't just survive. Some of them went up, while the tech bubble burst, while fortunes evaporated, while news anchors talked about the end of investing as we knew it. The quiet, boring, unglamorous companies with real earnings and low debt were quietly gaining value. Because when everyone is speculating in the same direction, the opposite side of the trade gets ignored, underpriced, forgotten, until it isn't. The smart money in a storm doesn't leave the table. It changes what it's betting on. Back to the teacher in Ohio, the engineer in Austin, the 29-year-old in Seattle. What happens if they do nothing different? If they ignore these signals, stay on autopilot, let inertia do the investing? Maybe nothing. 60% chance the recession doesn't come. Markets could stay elevated for another 2 years. The green lights hold. AI build-out pays off faster than expected. The Fed threads the needle. That's a real possibility. But here's what the asymmetry looks like. If the warnings are wrong and you do nothing, you're fine. You missed nothing. If the warnings are right and you do nothing, you are the Ohio teacher who never adjusts, who watches her 401k go sideways for a decade, who retires at 65 instead of 62, who recalculates everything 3 years before the finish line. The cost of paying attention is 0. The cost of not paying attention, if this plays out, is years. Not money, years. Time you cannot buy back. That's what makes this different from normal financial noise. This isn't volatility. This isn't a bad week. This is a convergence of long-term signals from credible institutions aligned in the same direction at the same time. And the people who will thrive, who will look back on this period as one of the great wealth-building opportunities of their generation, won't be the ones who called the exact top or bottom. They'll be the ones who had a plan before the chaos, written down, unemotional, ready. The plan is not complicated. It's not sexy, but it is the thing that has worked across every cycle in American market history. Here's the exact framework. 5 steps. Keep all of them. Step 1. Don't sell great businesses out of fear. This sounds simple. It is not simple. In 2008, 2 intelligent people I know made every right decision for years. They were ready. They had talked about what they'd do if the market fell in half. They said they'd buy more. Then 2008 happened, and the news said the financial system was collapsing. And they sold. At the bottom. And they watched from the sidelines as the market recovered. They locked in the loss, then bought back in at higher prices because they needed to feel safe before re-entering. The market took their fear and charged them for it twice. A falling price does not mean a business got worse. It often means it got cheaper. Those are not the same thing. Step 2, keep buying steadily. Dollar cost averaging is not exciting. It has no ticker symbol. Nobody makes a YouTube video about it, but buying at regular intervals. Every paycheck, every month, regardless of what the market is doing. is the mechanism that turns bear markets into gifts. When prices are low, your fixed dollar amount buys more shares. Automatically, without you having to be brave in the moment because you made the decision to be systematic before the moment arrived. Step 3, hold some cash, not out of fear, out of readiness. Cash on the sidelines isn't a failure of courage. It's ammunition. It's optionality. When a great company that you've studied and followed for years finally drops to a price you've been dreaming about, you want to be the person who acts, not the person who wishes they had something to deploy. Step 4, build your watch list now, while it's quiet. Write down the businesses you believe in. Write down the price that would make each of them a deal. Do the homework in the calm, so that in the chaos, you're checking a list, not making decisions under pressure. In crisis, the mind narrows. Options disappear. Fear writes the script. The antidote to that is a piece of paper with a price and a company name written on a Tuesday afternoon when nothing is happening. Step 5. Focus on quality, not lottery tickets. This is the specific call from the Bank of America analysis. The thing that's flashing red isn't quality. It's the speculative, hyped, narrative-driven, expensive on every metric stuff. The things people buy because they went up. What holds value in downturns and explodes in value after them is the opposite. Companies with real earnings, manageable debt, durable competitive advantages, and the financial strength to survive a period of economic contraction. Charlie Munger said it best. When a recession ends, the profits of quality companies spring back like a coil. The compression is temporary. The release is violent. You want to own the coil before it releases. These 5 steps only work if you follow them the same way every cycle. Not when you feel like it. Every cycle. That's principle-driven investing. You're not reacting to headlines. You're executing a system you chose when you were thinking clearly. And here is the phrase that governs all of it. Price is what you pay. Value is what you get. In a market flooded with noise, that one sentence is a lighthouse. When price is below value, you act. When price is above value, you wait. Everything else, the headlines, the predictions, the fear, the greed, is just weather. It changes. The principle doesn't. Here's the honest ending to this story. Nobody knows what happens next. Not Bank of America, not Zandy, not Buffett, not this video. What we know is that 7 warning lights are on, that the market is expensive by almost every measure, that the Fed is limited, that the economy feels tight. What we also know is that the market has survived every single warning before this one. The Great Depression, the 1970s, the dot-com implosion, 2008, COVID. Every single time, it recovered and made new highs. And people who owned great businesses at fair prices were rewarded. The question isn't whether you should be scared. The question is whether you're the person who gets scared or the person who was already prepared. Financially aware people don't follow headlines. They follow patterns. And this pattern has a name, a history, and a playbook. Now you have it.